Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I want to look at Crocs Inc. That's right, the company that makes horribly ugly shoes that somehow makes a lot of money. I asked a couple people at work if they actually own Crocs, and most of them said no, but I still see these all around the place. There are collectors who basically collect a ton of these. They really exploded during the pandemic for whatever reason, simply probably because people wanted something comfortable to wear around the house. And they've sort of at least maintained that level. They're not really growing anymore, but they've maintained a level of revenue that I thought was quite impressive for what they sell. So I wanted to look at the stock since it's had a bit of a dip lately. Still not too far from all-time highs. Certainly has done well in the past couple of years, especially since the pandemic. But we'll see what this looks like and whether it's worth investing in Crocs. As always, this is a video for entertainment purposes only. Please do your own due diligence before you make any investment decisions. So, Crocs, like I said, they make shoes. These shoes, some people like, some people think they're absolutely hideous, but they still sell. Recently, they've done a lot of brand collaborations. You can kind of see there's a deal with Barbie that they're making Barbie type shoes, and Barbie is huge right now. Some of these have decent reviews, some of them do not. Certainly you run the risk of diluting the brand with releasing way too many shoes with way too many styles. They have these Gibbets Charm shoes, which are basically shoes you buy that have little holes in them, and in these holes you kind of personalize your own little charms into them. And they've also done shoes that are collaborations with famous people, brands like Balenciaga, where they have $700 Crocs on sale, $800 Croc material bags and stuff like that. It's all very insane to me, but at the end of the day, sometimes you make investments in products you don't personally like because a lot of other people like them and because the financials on them are fantastic. At the end of the day, these shoes are not very expensive. They're in that $30 to $60 range for the most part. Obviously, some of the collaboration ones that are more collector's items cost a lot more, and people still buy those. But for the most part, these are relatively affordable. I think a lot of people who are focused on comfort, a lot of people with kids really like them because they're colorful, they're fun, they're kind of a way to show your personality, etc. Whatever. Recently, they also acquired the Hey Dude brand, of like more comfort-based shoes, kind of casual shoes. And reading more about this deal and looking at the recent earnings, I don't know if this was an amazing deal. I think one of the reasons the stock has gotten punished recently is that the recent earnings report has shown that this Hey Dude deal has not been growing as fast as the market expected it to grow. One of the things that you think about when you look at shoes like this and shoes like Crocs in general is that fashion can be very fad based. People like something for a while and then they don't like it anymore. Now, one thing that Crocs has going for it is there's a brand cachet with this type of shoe, but they had a patent for the material that makes up Crocs, and that patent expired in 2020. They've also had a manufacturing patent for the way they make these shoes, and I think that patent expires in sometime in 2023 actually. So there's already a couple of bootleg versions of Crocs. They've had some litigation in the past around, hey, you're selling bootleg Crocs, you can't do that. But as you go on Amazon, yeah, there's Crocs out there, but you also see Croc-like shoes, like whatever Che Chax is, the sponsored um, type shoe that looks like a Crocs that sells, for maybe slightly less than Crocs, although it's not really that much cheaper. So I don't know if it's a competitor really. The one thing Crocs has going for it is one, they have that manufacturing process that they've done over years and years and years. They have the brand cachet that is going to be difficult to build up, and their product isn't that expensive. So if I go on Amazon and I'm looking for Crocs and I see something else that might be $5 cheaper, it's like $30. Might as well just spend $30 on the brand name product that I know is going to be good. And if you look at how many of these Crocs are listed and how many reviews they have, you can kind of see how well this company has done. I mean, Jesus Christ, 516,000 reviews. at a 4.8, people be buying Crocs. So let us look at their earnings presentation before we kind of look at the financials, because the financials are very interesting for this company. If you don't think this is a fad, if you think they can maintain at least some growth going forward, then the financials here are very, very interesting. Very, very interesting. At today's prices, you're basically getting 8% cash flow yield, which, if that continues to grow, gives the company a lot of optionality. This is even at today's prices at $92, only a sub $6 billion market cap company, about sub $8 billion in enterprise value due to the debt they took on with the Hey Dude acquisition, which, if they didn't make that acquisition, I would probably like this stock a lot more for various reasons, but I'll talk to those in a second. So Q2 was just announced a couple of weeks ago, maybe 2 to 3 weeks ago. The stock dropped about 11, 12% when that was announced, down to like low 100s. And since then, it's dropped another about $10, down to 92 as of today. I think pre-market it's down to 91 since the market's down today. So quarterly revenues of $1 billion. Again, pretty good. Crocs brand revenue of $833 billion. Hey Dude brand of $239 million. Kind of a problem here. Constant currency growth, 3% growth on Hey Dude. Not fantastic. This is a brand that has grown a lot in the past 2 years. But the question investors are asking themselves, and I'm asking, did they overpay $2.5 billion for maybe something that's going to get you $800-900 million in revenue? Don't know what the operating margins on this brand specifically is, but Crocs is somewhere in that 20 to 30% range, depending. So maybe you're making 100 to 200 million on the Hey Dude brand in operating income if you're lucky. Maybe there's some optimization they still have to make, but that's essentially 10 to 20x, 10 to 15x multiple on an assumed operating income that might be better than I may be giving them more credit. Kind of expensive, especially given what the market is giving the Crocs brand, which is already, which is bigger and growing at a faster rate, right? So the Crocs brand themselves has always gotten like a 8 to 10x multiple on a sales basis. They probably paid, 2.5x on Hey Dude, where the Crocs brand as a whole is getting maybe 1.5x right now. So did they overpay? Maybe, since this thing is growing at a relatively slow clip given the size of it. You would want it to grow faster. Direct to consumer is growing well. Digital growth is growing well. I think it's the wholesale part where they're struggling. And that is going to be a concern for these fashion, shoe-oriented companies. If there is a recession coming up, if there's a cutback on what consumers are spending, are these companies going to be impacted? Yes. Yes, they will. They will be heavily impacted. So that growth will probably slow down. And maybe that's why these stocks are kind of discounted right now. Although Crocs has always had the idea that this is a fad. This is not going to last. And, it's proven in the last couple of years that it's at least has some staying power. Is the market ever going to recognize that? I think it might take a couple more years to do that. So it's never going to get that multiple that maybe other consumer brands are getting until that couple of years, until that fad dynamic is kind of out the window and it's proven that it can stick around for multiple years. Because if you look prior to the pandemic, this was a stock that was kind of in that, we were getting 1 billion in revenue, but we were not really growing. We've hit that 1 billion revenue mark and we stayed that for years and years and years. And then the pandemic happened and it was like boom, explosion. Gave them a ton of free cash flow, gave them the ability to invest in something like Hey Dude. And time will tell whether that Hey Dude acquisition was a smart one. And it certainly added revenue to the company. But if that revenue is slow growing or not growing at all, that might be a problem. So let's look at something like Allbirds, which kind of went, that's Bird Global. Let's look at Allbirds, which is another shoe company that you might be familiar with. This went public a couple of years ago, and it's done absolutely terrible since it went public. Like if you look at the IPO was somewhere around $28 is what it premiered. I don't know what the selling price was, probably a lot lower. All that's done since then is it's dropped like a tank to 100 $1.31 right now, 95% return since IPO, negative 95% return since IPO. Valuation is driven by the fact that when this premiered, it was like, we have growth expectations that are going to be, 20 to 30% growth on a go forward basis. What's happened since then in this direct to consumer kind of brand, it's just not grown at all, right? It kind of plateaued around 300 million and then is expected to shrink in 2023. And if you go to their website, these shoes used to sell at full price, no sales ever. Now I get emails sent to me that, hey, there's a 70% off deal. So they're struggling right now in this direct to consumer space. It seems like that's not really the case for Hey Dude. They're still doing well on the direct to consumer side, but certainly these consumer shoe brands can be fickle. They can be hot one day and kind of out the window the other. So it takes a lot to make sure they're relevant and they're doing well. But at the end of the day, Crocs may be no longer a growth company like it was in the past 2 years, where it was growing at 50% plus a year for 2 years straight. The growth is certainly slowing, but it's still, it's up to $1 billion in quarterly revenue. That's pretty good. And it's still growing at low teens clip. Most of that driven by the Crocs brand itself. A lot of that is driven by direct to consumer sales, which is good. And then you've got Asia revenue that's really working well for the company. The product is doing well in Asia. And that's always nice to see. Again, we talked about Crocs and what they are. What the hell is this? This looks okay. I guess this looks okay. They are moving into different brand adjacent categories, right? They're not just making these weird looking shoes. They're kind of doing more dressy shoes these days. They're doing sandals, which are kind of, I'd wear a Croc sandal. It looks fine. I mean, I'd never wear something like this, maybe around the house, but it's just not my style. Doesn't mean it's not. Styles differ for people. It's not terrible by any means. I mean, I just said it's terrible, but you know, that's besides the point. For me, it's terrible, but for others, it looks cool. But they are, again, moving into adjacent spaces where sandals are now making up a decent part or the revenue, maybe 10% of the revenue. It's going to be about 400 million in revenue in 2023, growing at nearly 30%. People are buying sandals pretty often. It's just how it is. You can replace sandals quite often. Additional entry point to the brand, etc. Doing all these collaborations, silly looking things. But hey, look at this freaking mime in weird ass yellow boots. Somebody's going to buy them for $300. That's just the world. It is what it is. You have to deal with it. Yeah, as an investor, you have to kind of say that, hey, maybe this isn't something I get from a product perspective, but people like it and it's making a lot of money, so it's worth taking a look at. Asia is going to be an important driver of their growth. If you look at what's going on, basically growing the CAGR at 30%, almost more than half a billion in revenue as of 2023, and growing at an even faster clip than it was in the past couple of years, right? So it's now growing at a 47% clip, which is pretty freaking impressive. And if that continues, if they can kind of move that growth or keep that growth in the 20+% range for a while, that's going to be pretty nice. And they have a pretty good brand going. And they've done a very good job of kind of making their brand resonate with the younger audience, which is what's important these days. And I think that's an interesting thing with this investment, is that you're investing in a younger audience and their ability to kind of drive trends. And the question is going to be, is this trend going to stick around, or is it something that they're going to move past pretty soon? Because you've got, the TikTok audience that can really have an attention span that's relatively low. And if this thing sticks around for a while, then this is going to be a good investment as of today. If it doesn't, if a year or two from now, clogs are kind of out of the popular zeitgeist, it looks good on paper from a cash flow perspective, but it could be a problem if that happens. And again, you've got Hey Dude. Was this a good investment? You can listen to some post earnings discussions with the CEO, and he says, yeah, we're still happy with Hey Dude. He said it more enthusiastically than that. But I feel like if they had the chance to buy it today, they'd probably at least renegotiate the price. If they really thought that this thing, a year into owning it was going to grow at 3%, whereas their mature line of Crocs is growing at a low teens percent, they wouldn't have paid 2.5 million for it. It's just too expensive. I mean, these are fine shoes, but is this something that is going to be worth multiple billions in a few years? Because that's really what you would want from it, right? If they have the optionality to spin something like this off in the future, they want more than they paid for it. But if growth is slowing, if they're already trying to move these items with sales, if you go to their website, there's 25% off sales on certain items. Is that how it's always been, or is this a new thing? Because that could be a negative issue for them going forward if they've got this brand that's kind of a negative to their growth story, right? You still want some sort of growth here on a go forward basis, but even if that growth is muted in the near term, that's fine. It's just, what are they going to do to get Hey Dude to a growth pattern going forward? Because I'm not sure yet, right? That's the question mark. That's the concern here. Yes, they have really amazing total brand revenue growth, but if it's starting to slow, that could be a little bit of a problem. But we'll see. I mean, this is still a brand that I've never heard of until I started looking at this company, which is potentially a problem. But it's also a brand that I've never heard of, and I'm not really all on the up and up with brands. So there's potential to reach other consumers because these are the type of shoes I might be invested in. They look comfortable. They're not necessarily my style in a lot of ways, but they're decent looking. And it's a brand that I've never heard of that's already reaching, almost $1 billion in revenue. So it's a pretty decent brand from what it seems like. It's not terrible, but they do need better growth for something this early in their life cycle, especially right after they bought it. The one thing they can do is, even if the growth isn't there, they can obviously look at the cost structure. They can put their manufacturing expertise to the Hey Dude brand and kind of improve the margins that they're getting from the $1 billion in revenue that they might soon get from it. So at the end of the day, if you're getting 20 to 25% margin on $1 billion in revenue, a 10x multiple, if they can achieve that on their $2.5 billion purchase price, doesn't seem that bad, but I don't think they're there yet. So they might have to get there. Looks like their digital growth is really good on the Hey Dude brand, but the overall growth, not that amazing. So that's something that they'll have to fix via whatever they do. So in one quarter, this company makes, $3.4 in EPS, pretty solid operating margin. Again, like I said, 30% on the overall Crocs brand. How much of that is in Hey Dude? Probably a bit lower. But with growth slowing there, they'll probably have to improve that to kind of get to that point as well. If we look at their historical growth since they bought it, I think the historical margin since they bought it, we can kind of see where that is and where that was when they bought it. So see how well they've done. Revenue there, revenue growth on Crocs and the brand itself, really solid. Sandals are the standouts here. The Jibbits are doing well. It's a fun name to say. As you look at the revenue, Asia Pacific is obviously the highlight here. Direct to consumer is great in Asia Pacific and EMEALA, but overall revenue growth in EMEALA is mediocre, actually shrinking. But North America and Asia Pacific, especially Asia Pacific, are doing well. Then as you look at the Hey Dude brand, direct to consumer is great. Wholesale sucks. The brand overall is pretty good. Kind of okay, rather. Sorry. And then as you look at gross margins, this is what I was talking about. Crocs is amazing at 62%, their manufacturing process, etc. Again, they're going to lose the patent on that process. Is anybody else going to cut in and be able to get them at a lower price point? Is that going to put pressure on their margins? Hard to tell. Potentially, probably not though, because they have such a brand cachet, but you never know. And then Hey Dude is about 15% lower than that. So they're not making headwinds and improving those margins, which is a bit disappointing to see, especially with lowering growth. But they potentially have some upside there if they can make that work better, right? So as you look at operating margins, Crocs 38%, Hey Dude actually down about 5%, which is not amazing from last year, pushing the overall operating margin of the company down. this eventually has to be fixed, right? If there's any negatives I can see from this earning reports, it's the Hey Dude brand, right? Slowing growth, operating margins are getting worse, operating margins that are worse than the Crocs brand itself. They're still good though, right? They're still making money off of this product, which is a nice thing to see. Sometimes companies will buy something and they're going to lose money for it, and if that never turns around, that's a problem, but that's obviously not the concern here since they're already making money on it. It just needs to be better in terms of their operating margins. And it's a bad sign that it's actually moving in the wrong direction. It's hard to tell why that would be. The nice thing about Crocs, and we'll see that soon, is one, they are a free cash flow positive company. They are expected to generate about 500 to 600 million in cash flow, like I said, against a $5.8 billion market cap, $7.7 billion EV, enterprise value. And that optionality with the cash flow, 500 to 600 million a year, allows them to, one, buy back shares, two, deleverage quickly. They went from a 3.1x gross leverage to a 1.8x in Q2 2023. So they've basically repaid 850 million of the 2 billion or so they took out for the acquisition. So they do a good job of doing that, but still there's going to be some pressure on their bottom line due to the interest they're paying on that debt. So I would like to see them deleverage quickly, get rid of that overhang, and kind of start buying back shares as well. And also potentially making other investments. One thing you want to see is what the inventory position is for a company like this, that they're not seeing inventory grow, meaning people are buying less and less of their product, which they're not seeing here, which is a good thing to see. And then we're looking at the overall guidance. Again, growth is slowing. It's not going to be 50% again like it was in the past year or two since the pandemic, but it's still growing. That's the nice thing to see. The problem is that it's Crocs that's driving everything. And Hey Dude, like I said, is starting to slow. Prior guidance was for mid-teens growth. Now it's anywhere from 3.5% to 7.5%. So kind of mediocre. The good thing is that it is being offset by better operating margins. I think some of that is just from better efficiency on the Crocs brand, since Hey Dude is pressuring margins like we saw before, small one-time costs. But you're talking about expected EPS around that $12 mark. So as you look at the current price today, you're talking about a $92 share divided by 12, 7.6 PE. It's pretty good. A 7.6 PE is pretty good. So as we look at the price here, a 7.6 PE basically says that the market is looking at this as kind of a no growth company. They're still valuing it in a way that tells me that they think it's a fad, that they think it's not going to last, that they think things are going to change. Because if this company can continue doing what they're doing, then today's valuation is a freaking gift, right? Now, the company is still, doing well for investors even after the recent drop. It's up 20% in the last year. It's up 35% a year in the last 3 years. It's up 36% a year in the last 5 years. It's up 21% a year since, in the last 10 years. And since it's been a publicly traded company, it's up 12.9% a year. So a good investment, especially in the last couple of years. As you look at their valuation history, price over earnings kind of has floated up and down, but it's kind of back down to where it was at its lows this year. And then if you kind of go back into the 3 to 5 year space, even around 2020, during the pandemic, it's kind of bottomed out at 6x. The lowest it's ever been is at 4.4x. The highest it's ever been is at 48.5x, kind of when it was starting their growth patterns there. But that just kind of shows me that, hey, today's valuation at 7.2x, not too bad, guys, not too bad. Market is clearly valuing this poorly. It is looking at this as a company that doesn't have the ability to continue their growth, doesn't have the ability to last, which I'm not sure is realistic, right? They're going into 2023. You could say it's a time where a lot of people on the main street are having financial issues and they're still able to grow their revenue. Now, does that mean they're going to be able to grow their revenue if a full-blown recession breaks out? We probably have that data. No, In 2008, for example, revenue dropped 14%, 10% in 2009. So they are going to take a hit on the revenue side. There have been periods of time where the revenue has dipped. And like I said before, this was a company that was kind of just flat for a long, long time. You basically went from 2011 to 2020, right before the pandemic, with barely any growth. But even during that time, they were a company that was free cash flow positive outside of a couple of years. So they didn't have to take on a ton of debt. They didn't have to do much to self sustain. And they're in a position as well right now where they give investors in this company a lot of optionality because this is a company that's going to take in 600 to 700 million in free cash flow. They're going to use that money to pay off debt. They're going to use that money to buy back shares. They're going to use that money to invest in their business. And they could potentially use that money for other acquisitions, which gives them a lot of optionality, which, given the price point, makes me feel pretty good about this investment at this price point. I potentially will open a position here. So FYI, I may be long Crocs soon or even before this video is published. You look at this from a long-term perspective and you say, well, I can get 8% free cash flow yield in a market right now where that's not super common, and this is a company that may potentially grow, even if it's at high single digits, even if it's growth that doesn't come for a year or two, even if they stay at 4 million in revenue for a while, they can buy back a ton of shares at this price point, especially if the price gets pressured down anymore. They can pay back debt pretty quickly because they're generating free cash flow, because they're so efficient in their operations, because their free cash flow margins are close to that 20% range, which is really good. Their operating margins are close to 30%. Actual net income margins are close to 20%. It's pretty freaking solid, especially today compared to some other companies. I do think there's some risks here. One, patents are expiring. There are going to be copycats that come in here, might put pressure on their revenue, on their sales, potentially cause them to have to lower their margins. Two, the Hey Dude brand is slowing. Operating margins dropped 500 basis points in the last 12 months. Not great. Maybe the acquisition was poorly timed. They overpaid for it. If they can't get that back to growth, it's going to be a slight overhang on the overall company. They might have just been better off staying as a Crocs brand. Sure, they wanted to do something else, kind of get some other growth avenues out there, but we'll see how that goes. Three, are Crocs a fad? People say, well, it's been around for so long, but it's been around for so long, yes, but it's only been around in this big way, in the big Crocs wave that has kind of hit the popular zeitgeist for 2 to 3 years in reality, right? They were a much smaller brand a couple of years ago. They're much bigger than they are now. Are they going to be able to maintain that 4 billion plus level of revenue for the foreseeable future? Is this the new norm? If this is the new norm, then this is a screaming buy at today's price. If it's not, and fashion can be in and out really quickly, then you could certainly see this drop 50% in terms of the revenue pretty quickly as sales drop off. That's kind of what happens with certain fashion brands, but who knows? This isn't something I would make a large position, but a small position to start and maybe build it up a bit more. Is there some margin of safety built into here for a lot of those risks? I think so. You're getting 8% free cash flow yield on today's price, and that's current free cash flow yield. You're talking about 1.1 billion in projected free cash flow by 2027. That's 16% free cash flow yield at today's prices. That's pretty freaking good from a long-term perspective. Even at today's long-term bond yields that are in that 4 to 5% range, this still looks good against that. There are certain stocks today that are pricing at 2 to 3% free cash flow yield and future cash flow yield at 5 to 6%. I'm not comfortable with that given today's bond yields and risk-free rates, and the fact that a recession is going to come in the next couple of years. It's got to happen. We're so due for one. So I am a lot more in cash than I used to be, and it's fine given that Cash is giving you 4 to 5% yields right now, maybe more sometimes, depending on where you're sitting with your cash. But am I willing to maybe invest a little bit into this and see where it happens? Yes. Do I think this has the market can kind of look at this and say, well, it's even though it's an 8% cash flow yield, we just don't believe that you're going to be able to maintain that, and this is going to sell off? I think so. I think it could sell off a lot further. I mean, the story hasn't changed that much since the middle of last year, and the stock was as low as $50 back then, right? So I wasn't too aware of it back then, but am I going to set a target price here that if this hits 50 and the fundamentals haven't changed much, that I'm going to buy a lot of it? I think so. If this were at 50 again today, I'd be buying a ton of it. If it's at 92, maybe a little bit of a nibble. That's it for me. It seems like a decent company. Some risks here. Don't love the Hey Dude acquisition just based on the cursory glance that I took at it. But overall, this seems like a decent valuation for a decent brand whose shoes I don't particularly like, but whose shoes other people seem to like. And you can Google for stories of people who have 2,600 Crocs pairs because they are collectors, and it's people like that that seem to keep this brand afloat. And it's other people who enjoy the comfort that these shoes bring and the value that they give, since they're not that expensive, and that prevents it from a bunch of the knockoffs taking a lot of their lunch. So overall, seems like a decent investment today, the investment I might make. Let me know what you guys think about Crocs. As always, this is not financial advice. Please do your own due diligence. But let me know what else you guys want to see as far as investment analysis. Thank you for watching, and let me know what you guys think about Crocs. Thanks.